Okay, thanks to everyone that's joining here today. We're going to get started in just a moment. So, today's topic that I want to go over, I think, is a very important and timely topic, and that is IRS crypto tax audits. I want to give a crypto CPA's guide to Web3 tax resolution. Now, why do I think this is such a timely topic? Because this year and moving forward, I believe, and we've seen this indicated by the IRS, that we're going to see a large uptick in tax audits and enforcement from the IRS related to cryptocurrency and digital asset transactions. And you as a taxpayer want to be prepared for this. So, the IRS has been focusing much more heavily on crypto. They've always had a focus on crypto, and I've been tracking their focus on crypto for years, since 2016, and it has been, increasing and increasing over time, basically as we've seen the market grow. So you may have more recently seen the IRS has hired crypto specialists into their team from very well-known organizations such as Binance and Consensus to bring in more expertise onto their team. We see the focus from the IRS on data collection, and this collection can take many forms, whether that's via John Doe summons to exchanges or just to some of the proposed regulations that we see with the broker regulations, where there's going to be a lot more data collection and informational tax filings. And we've even seen public statements from the IRS in 2023 saying that they expect 2024 to see more tax enforcement and more criminal tax enforcement, specifically related to cryptocurrency transactions. And now in 2024, we have started to see some of these enforcements. We've seen the Justice Department in first indictment for a purely crypto tax evasion case with Frank Algren III, and he's been accused of filing multiple years of false tax returns, and if found guilty will be facing, I believe, 3 to 4 years for each count of filing a false tax return. We're talking about him filing multiple years of false tax returns. So we have this focus from the IRS, and also if you go on the IRS's website, they will, based off of all the information that they have and that they've collected, they're claiming a 75% non-compliance rate, meaning they believe only 25% of taxpayers are filing their taxes appropriately. So, that's another large reason why, they believe that there's a huge tax gap that they can start to close and start to get some revenue if they can successfully enforce a higher degree of compliance amongst these digital asset transactions. So that's why we're starting to see this, increasing focus from the IRS, and I only expect this to increase. So, what causes a crypto IRS tax audit is a question that I get a lot. And, it's not just one thing that can trigger an audit. There can be, multiple scenarios that can lead to your tax return getting scrutinized further. One of them can just be random selection. The IRS can randomly select tax returns for audit. So, this is something that you want to keep in mind. Oftentimes, though, there can be red flags that will trigger an audit. This can be an inconsistency in how you've reported your crypto over multiple tax years. It could be significant discrepancies that they see between your reported tax return and your lifestyle. If you're only reporting that you have 50K in capital gains from cryptocurrency, and your wages are 50K a year, and you're buying $1 million home, that can be an indication that maybe not all of your income is getting claimed. Large deposits from unknown sources, and if crypto is getting deposited into your bank, these are large deposits. If there's not correlated reporting with that, these can be other other red flags that are showing that maybe not everything's getting reported on your return. So, any sort of inconsistency like that on the return can lead to further inquiry. And then one that we're seeing a lot is third party information. So, this can be that the IRS collects information from an exchange via a John Doe summons, and they realize that a taxpayer hasn't reported the transactions that are material. And then, as a result, they'll trigger an audit based off of that. Or there can be 1099s that are sent from exchanges or from even a third party. You may be transacting on an exchange and they'll send 1099s about your activity, or you may get paid as a consultant from someone and they may send a 1099 denoting the payment that was made to you. And if this isn't properly filed and reported, then this can also trigger an audit. Even if you are reporting that information, but you're not reconciling the third party reporting and appropriately reporting that all on your return, you can start to trigger audits or red flags there, even if you actually are reporting it all. So you also want to be very careful with that reporting process. So there's several ways that you can trigger an audit, and there's different types of tax notices that you may receive even outside of a full audit, that are pretty common for right now for crypto. So, some of the common tax notices that you're going to see are going to be notices 6173, 6174, and then 6174A. So these are all related to crypto. These are informational notices. These aren't full audits. But when you get these notices, it's still something that you want to treat with care and you want to address appropriately. So, the most serious out of the three is notice 6173, which indicates that the IRS has strong evidence. It's usually going to be, transactions they've gotten from someone, like I was saying, strong evidence that you've participated in crypto transactions between 2013 to 2017, and that you likely didn't report these on your return. This notice requires a response within 30 days, and then you possibly may have to amend your returns, recalculate your crypto, make tax payments. So we see this notice a lot. A lot of times people have not been reporting their crypto for years. Then they'll get this tax notice, and then they'll reach out to a firm like us, because then you're going to have to take these steps to get into compliance. So there's also notice 6174, which, this is more, it informs you that the IRS suspects you may have underreported your crypto income, but doesn't have conclusive proof. This doesn't require a formal response, but it strongly encourages you to review your past returns and amend them if necessary. And, if you do get this notice, you should contact a firm like Caboose CPA and do just that. And see if your crypto accounting is accurate, if you're missing any data, and ensuring that you've claimed this appropriately. And then there's notice 6174A, which is pretty similar to 6174, but it emphasizes more that there's a possibility of future enforcement action from them if you don't address it. So these are some of the notices that you can basically expect, but I also want to briefly outline, like, what does the audit process actually look like if you do go under an audit. And the way that this will start will be with an initial contact letter from the IRS. Most of the time, the way that most of these things are initiated with the IRS is via mail. If you do get a phone call saying like you owe the IRS money, I would be highly suspicious of that. That's how a lot of scams are conducted. So it does start with this initial letter. It's the first formal notification regarding an IRS audit. It's going to, tell you the tax years that are under examination, the general scope of an audit, and then, they're going to move into an information request, usually with Form 4564. So, they're going to formally request a lot of tax documents from you that are going to help to facilitate the audit and bring it to an appropriate conclusion. So this is going to include copies of your tax returns for the years in question. It's going to include all of your detailed transactions for your cryptocurrency activity and your full audit trails. It's going to include all of your wallet and exchange information. They'll likely ask for a list of all your non-custodial wallets, all the exchanges that you were active on, and all the associated transactions. Statements from any cryptocurrency exchanges you were using, as well as bank statements too, because they will look at verifying the transactions from you on ramping to the exchanges. And they may ask for other sort of information, such as like what accounting method are you using, and other pieces of information, read transactions or the documentation thereof, basically. So after you get all that together, your IRS agent is going to review that all, and they're going to do their own analysis. And once that's complete, you'll basically get what's called a CP 2000 notice. And this notice is going to inform you of the proposed tax changes. So they're going to look at all the facts and circumstances and do their own analysis and determine, if something was reported inaccurately. And then as a result of that, they're going to give you this notice, and they're going to say you owe X amount of dollars, and these are the reasons why. Once you receive that notice, you do have a right to dispute those proposed changes in a specific time frame. Now, obviously, this gets situational, so I can't really say, exactly how you should dispute it for your given scenario, because it's going to depend on exactly what's getting scrutinized, exactly what your position is, and based off of that, you can decide if there's an avenue for you to dispute it. And then, you and your tax advisor would want to take the appropriate steps for that. Next step would be that you're going to receive a final audit report that's going to, summarize the findings of the audit and determine your final tax liability. Now, during this process, the IRS could also, issue summons to obtain information from third parties, such as exchanges or other third parties that have your information. So even if they can't get the review, there can be other methods that they can use during the audit process to obtain some of this information. So again, what they can collect: tax returns, transaction records, wallet information, exchange statements, and bank statements, the accounting method you're using. So all of these aspects they're going to consider, and they're going to look for discrepancies in your accounting, and that's how you're going to get this CP 2000 that's going to tell you that you potentially owe more than you claimed. In terms of the statute of limitations, the IRS can generally go back 3 years to audit your returns. However, if you're significantly understating your returns by 25% or more, that 3 years can go up to 6 years. And if your returns are considered fraudulent, they can go back indefinitely. So there is a statute of limitations, and consider that how it applies to you if you do go under an audit. But understand that it can be 3 years, 6 years, and sometimes indefinitely. So it can change depending on your facts and circumstances. So what are some of the key areas of an IRS audit as it relates to cryptocurrency? Firstly, I think like the lowest hanging fruit that they're looking towards is going to be people that are, significantly underreporting, or just people not reporting at all. And that's what we see a lot right now. A lot of these preliminary tax notices are just notifying people who haven't reported that the IRS has their information and that they have to report. And usually I will say when people get those notices, they're much more inclined to report. Before this, maybe they just thought the IRS isn't paying attention to crypto, this and that. But when they get that notice, they take it much more seriously in most cases. So I think non-reporters are a huge one, but also people that are applying incorrect tax positions. And I think an easy one for the IRS to go after, that's another low-hanging fruit, like non-reporters, are people that are applying, HIFO or LIFO across their whole entire portfolio. In many of those people, I see a lot of prospective clients come in where they're trying to do HIFO across their whole portfolio. When we do a further analysis on it, they're not managing their funds on chain in a way that's going to facilitate them using specific identification. And when you use HIFO, you're really just using specific identification, but you're applying the same tax treatment across the board for all of your assets. So if these assets were not managed properly on chain and they're just a bunch of fungible cryptos that are commingled between wallets and exchanges, it's unlikely that Spec ID is going to stand up to an audit. And if it doesn't, Spec ID doesn't stand up, you're going to have to revert back to FIFO. So I think that can be a fairly large audit adjustment in many cases. So looking at the accounting method selection, scrutinizing that and the documentation and the flow of on-chain funds, I think is going to be a huge audit focus outside of just looking at non-filers. I think those are sort of, two of the lowest hanging fruit. But then, you also want another area of focus is going to be the treatment of certain transactions, meaning, are you reporting all of your cryptocurrency income appropriately, with probably a heavy focus on staking and rewards, as well as certain DeFi protocols, because the treatment there, sometimes taxpayers are trying not to treat income as such when it should be, whether it's with staking or with specific protocols. So, there can be a focus there and tax adjustments that are going to be made just based off of, reporting income from certain types of crypto transactions where taxpayers may be trying to defer that. And then, obviously, looking at your capital gains calculations, that will be a focus. But I think, looking at, are you under reporting? Have you applied the incorrect accounting method, or are you just treating transactions that should be treated as income or should be treated as taxable as not taxable? I think these are going to be the lower hanging fruit before they take the steps to actually do a calculation on your accounting, see if you're calculating your gains and losses correctly, if you're just overlooking certain micro purchases maybe for capital gains purposes. I think this is also a focus, but the lower hanging fruit I think would be addressed first. And then, once you're going through that calculation, another important step is that I see going overlooked is that there's no really due diligence going into the calculations. And a lot of times you'll see ending basis completely incorrect, whether, it's overstated or understated. There'll be assets that are just not calculated correctly. So I do think there's an opportunity for the IRS to partner with service providers and software providers, use the transactions they collect, and do their own accounting calculation, and to determine the accuracy of your calculation. And if there is a large discrepancy, then you could get hit with an adjustment there as well. Lastly, just overall, this kind of relates to the income point that I made, but just overall verifying your positions as a taxpayer. Even outside of just staking income, you can see people that sometimes are going to take certain tax statuses as traders and try to deduct certain business expenses where they may be disallowed. You may see people that are hitting in investment activities involving this, and they may try to claim that this rises to the level of a trader or business where it doesn't. And that would be another type of tax position that likely can get adjusted and result in large tax changes. And there's many of other tax positions that are going to get very specific to the type of business or investment activity, the type of protocols and assets that you're in. But this is another area that can get scrutinized, and that will get scrutinized, and I think is fairly low hanging fruit, because it doesn't necessarily require them to go through a whole calculation to identify someone that's taking an incorrect tax position on something like that. So obviously, it's key for you leading up to these audits, and when you're doing your accounting and taxes every year. I talk about this all the time. Record keeping and documentation is going to be the key. You're going to want to maintain a full audit trail and full records of all of your accounting transactions, and you're going to want to appropriately document this, including contemporaneously documenting the tax positions that you take on your return. So, having meticulous records and performing your accounting and taking tax positions correctly up front, you know, demonstrating compliance, that's the best way to minimize your audit risk. And of course, we're going to want to use, all the tools and resources available to streamline this process and, ensure that we're building good audit trails. And there's many softwares out there that can help with this. But it all comes down to record keeping, and like I always say, audits are won before they start. So if you're taking the right steps in 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 taking positions that are more likely than not to stand up to an audit, you're contemporaneously documenting them, and then you're accurately accounting for all of your transaction activity. That's how you avoid an audit. And like I said, it's avoided before it even starts. So, of course, if you are navigating an IRS audit, I highly recommend that you work with a CPA that is experienced with both tax resolution and digital assets, because they're going to help you navigate this whole entire process. They can take you through the audit process. They can represent you before the IRS. They can negotiate on your behalf. They can also perform the crypto accounting for you if it does need to be reworked. And that's something that my firm does at Camuso CPA. So if you are going through this process or worried about this process, reach out to me and my team, and we're happy to assist you with that. But working with a CPA can help you, understand the whole process. They can deal with the IRS with you, and they can also assess your activity and help you accurately calculate it and take the correct tax positions on it. When you're going through the audit process, of course, cooperation and transparency are extremely important throughout the process. And that is something also that your CPA can assist you with, rather than you just dealing directly with the IRS. So that's what I recommend there. Now, if you do go through an audit and there are proposed changes and adjustments that are made, there's several considerations or resolution strategies that we want to consider and assess. Now, I'm not going to dig into like deep detail on each one of these, because they all are sort of facts and circumstances based, and they all may not apply in every scenario. But there are certain things we want to consider. Firstly, if you're being audited, we want to consider, how does the statute of limitations apply to your scenario? Are we on a 3-year limitation, or are we looking at something past that, and does an exception exist? Or are we precluded from even going down this road because maybe we can make an argument for statute of limitations? Is there a way that we can substantiate the positions that you've taken on your return to avoid penalties and a potential proposed change to your tax return? Is there a reasonable cause defense that we can take? Basically, demonstrating that we have a legitimate reason for errors or omissions, related to lack of clear cryptocurrency tax guidance, or reliance on a professional that you worked with. So we want to look at those types of preliminary strategies to just see, is there any way where we can easily address this? If we can't look at something like a reasonable cause or just the statute of limitations, then we need to look at, can we apply a first time penalty abatement, where if this is the first penalty you received for unintentional errors, oftentimes we can abate those if you have a clean compliance history. Or do we want to look at something such as an offer and compromise, where we can negotiate a settlement with the IRS where you're going to pay your tax liability, but potentially not the full amount? Or in that regard as well, a partial payment, where the IRS can accept a partial payment compared to the whole tax payment as a show of good faith, and hopefully have you reach a resolution with them that can have less money come out of your pocket than paying the full amount. And we also can look at installment agreements. So if you do owe a lot of tax debt after we go through the audit process, we can potentially also spread those payments out over time. And there's other resolution strategies outside of this, but firstly, we want to look at, is there a way where, we can sort of prevent this process from moving forward by creating some type of defense, substantiating our position, or just applying a statute of limitations? If that doesn't fit, then is there a way where we can, look through a first time penalty abatement or some type of offer and compromise or partial payment where we do have to settle with the IRS, but hopefully for a lower amount than the total proposed change? And if none of these options work, that's when we want to just maybe look at an installment agreement and start spreading the payments out over time, or looking at other options outside of this. So again, as you can see, especially when you're getting into the resolution side, working with the tax professional is extremely important, because you're going to want to use the best options available to you, and a tax professional, specifically a CPA, is going to help you, given your specific set of facts and circumstances, assess which one of these options is going to be the best and lead to the best outcome for you, and result in the least amount of additional taxes, penalties, and interest being paid. So that's why professional representation is key. Working with a CPA that is experienced in tax resolution and digital asset taxation is going to go a long way in just understanding what's taking place with your fact pattern, but then also having a CPA in your corner with negotiation skills that can work with the IRS during an audit is going to lead to the best overall outcome when you're negotiating a settlement with them as a taxpayer. And lastly, I should mention also that we can appeal the audit findings. So you as a taxpayer have a right to go to the IRS's appeals office and appeal an audit finding as well. So, that's another avenue that we can go down if that fits your specific facts and circumstances. So overall, I want to stress, these resolution strategies and even like the areas of focus when it comes to a digital asset audit are going to depend on the unique circumstances of each case and each taxpayer. And that's why, again, it's crucial to work with an experienced crypto CPA. But even better than that, than working with an experienced crypto CPA on the audit process, would be if you work with one before the audit process and avoid this altogether. And my firm at Camuso CPA can assist you on both sides. So if you want to be proactive in your cryptocurrency accounting and tax compliance and you're not in the audit process, our firm can help you stay in compliance and avoid an audit with accurate accounting and proactive tax advice. But if you do find yourself in a scenario where you've received a tax notice or you've received an initial contact letter and you're going to go through an IRS audit or inquiry, reach out to my team at Camuso CPA and we can help you navigate this process, accurately calculate your cryptocurrency capital gains and overall transactions, work with you on accurately reporting this and negotiating with the IRS to get you the best tax resolution outcome that's available to you for your specific facts and circumstances. So I hope you guys got value out of this today and got some insights that can assist you as a taxpayer. But if you do need assistance on any of these fronts, feel free to reach out to my team at CamusoCPA.com, and I'd be more than happy to speak with you one-on-one, learn more about your scenario, and see where we can help. So again, I hope you got value out of this webinar today. I appreciate you guys taking the time to watch. Until next time, I'm Patrick Camuso, signing off.